Scott, to what extent are the markets for commodities, currencies and shares being driven by traders on the back of huge liquidity and low interest rates?
Well, I think obviously the environment that we've experienced over the last 18 months has been characterized by huge volatility, and traders have been leveraging off of that volatility, and it's created, particularly at end of day market cycles, artificial activity in the shares markets. I think what we're seeing now is what I'd characterize as a return to normalcy, where volatility is abated a bit, and you're seeing activity in the shares markets really driven by supply and demand, with a return of liquidity, particularly in the fixed income markets.
And does that return to normalcy include a return of hedge funds? I mean, you do a lot of servicing of hedge funds in State Street, perhaps not in your area, but are we seeing a lot of hedge fund activity?
We have seen actually a bit of a reversal in the hedge fund industry. Throughout 2008, we started to see hedge funds, particularly the individual strategy hedge funds, take a reversal under some pressure. So we've seen an explosion in the number of hedge funds out there over the last 5 years, and we've seen a bit of a reversal of that in the last 18 months. Some would predict or forecast that up to 30% of the hedge funds that existed a year ago wouldn't be in business a year from now. At State Street, we do provide servicing on the administrative side for hedge funds through a division of our company. That business has continued to grow quite well. It tends to focus on the larger, more established hedge funds, and those hedge funds are continuing to do quite well, both in gathering client assets and I think in delivering on the return expectations that people have for hedge fund investments. So that is a part of the growth segment of State Street overall.